Good morning. My name is Garth Jestley of the Middlefield Group, and it is my pleasure to welcome investment advisors from across Canada to this special presentation relating to Active Energy Income Fund. This presentation is coming to you live from Houston, Texas, where I'm joined by Henry Groppe, who is the founder of Groppe, Long, and Littell, a Houston-based consulting firm that has great expertise in the areas of oil and gas. The Active Energy Income Fund offering has been going very, very well, and I would remind investment advisors that it closes next week, Tuesday, November the 16th. But our purpose today is really to get an update on Mr. Groppe's outlook for the energy sector. Just by way of background, Henry Groppe has been involved in the energy business for over 50 years. He is a chemical engineer by training. He worked with Dow Chemical, Texaco, Arabian American Oil Company, among others. And his firm has developed a strong reputation for doing fundamental analysis of the forces which come together to create energy prices. So I'm delighted to be with you today, Henry, and looking forward to getting your update on the whole oil and gas sector. Henry, I think if I had to look at all the questions that have poured in anticipation of this interview, the number one question on the minds of everybody is, where are oil prices going? We've seen exceptionally high oil prices over the last year, and of course, you always have the pundits who are of the view that what goes up must inevitably come down, and they point, of course, to history. Where we've seen at various points in time very high energy prices, for example, the early 80s, which then plummeted as new supply came on board and so on. So I guess the number one question that we're being asked today, and I would pose to you, is, is it different this time? Is it different today from back in the early 80s?
That's a very, very good question, and one that is on nearly everyone's minds these days. And all of our work indicates that there's some very profound differences in the current environment in comparison with the last major energy crisis in 1980, which followed the Iranian Revolution, which took approximately 6 million barrels a day of oil off the world markets. At the present time, we've been through a long period following that, after prices collapsed and with low prices, during which time we've done all of the easy things to do to continue to maintain production or try to grow it. Also, the world has been continually working at using oil and gas more efficiently, so it takes higher prices currently to get the same kind of demand response that it took in 1980. In inflation-adjusted terms, at the peak in 1980, prices reached $80 a barrel for WTI. And nearly all of the factors that we examine now have differences that would tend to create more upward pressure on prices to achieve the same demand response that price achieved in that first crisis. We therefore expect oil prices to be rising continuously into the future in order to achieve the necessary demand destruction.
Henry, what was some of that low-hanging fruit, if you will, in terms of demand destruction that was eliminated back then that we don't really have available to us today?
It's not really understood and appreciated that most of that reduction in consumption, and there was, in response to that more than doubling of prices in '79 and 1980, there was approximately an 8 million barrel per day decline in consumption, and essentially all of that was achieved by substituting cheaper fuels for the use of fuel oil, where the use was just in terms of deriving the heat content by burning it. There was actually no decline during all of that time and the use of oil for transportation fuel, which is the hardest to substitute. It's its highest value use, and it's been the rapidly growing use. For example, in the United States in 1980, we were using approximately 4 million barrels a day of heavy fuel oil for power generation in the northeast part of the country. And that represented some 22 to 23% of our total oil usage at that time. Since that time, we've had great substitution of natural gas, coal, and nuclear, much cheaper fuels, and we're down to very, very little usage of heavy fuel oil now. So the easy demand destruction has already been achieved.
Henry, pulling this this together, have you translated that into a price expectation? For example, for the year 2005, an average price expectation for WTI?
Correct. We anticipate average prices for 2005 of approximately $50 a barrel, and that's an average of lower prices during the early part of the year. Historically, absent any unusual weather event or supply disruption event, prices for both oil and natural gas generally peak in September, October in anticipation of the peak demands for the winter heating season. And if we have normal weather, then by February it's clear that most of the winter demand is past, everyone's pretty relaxed, and we traditionally get a significant decline seasonally in those prices. So we would expect WTI to move down toward probably the $40 per barrel range by February, but then be in the high 50s again during the latter part of the year as we approach the next heating season, because all of our work indicates that there is more and more pressure on being able to maintain oil supplies.
So I guess what you're saying, Henry, is you know, people tend to get very fixated on the day-to-day movement in the price of oil, and of course we're up in about $55, and now we've moved back down, and so people tend to extrapolate the most recent circumstances. But I guess what you're saying is that volatility is to be expected, and there are seasonal issues that always come into play. But overall, pulling it all together, you see $50 average price.
We certainly do. Oil prices rose during the last couple of months, first for the basic reason that I mentioned, anticipation of the heating season, plus one specific one-time event, and that was Hurricane Ivan, that was particularly impactful in terms of major movements of the sea bottom, which moved or ruptured a number of the oil pipelines. And so for some weeks we've had almost 500,000 barrels a day of high-quality sweet oil production in the Gulf disrupted, which is gradually being brought back on.
Right. One of the most common comments that one sees in the news is the so-called terrorist premium, and I think the theory is that if one looks at the price of oil, embedded in that price is some terrorist premium, and I guess the implication is that if only this terror were contained, this premium would disappear from the price of oil and it would go to some more fundamental and lower level. What's your thought on that terrorist premium concept?
That's been a very interesting phenomenon to us as we've observed this for the last couple of years. And I think it can best be understood by remembering that when oil was $23 or $24 a barrel, and that was a surprise to everyone, having risen from the $20 or lower level, the theory was that there was a $3 to $4 terrorist premium to help explain why oil prices had moved up in contradiction to the consensus forecast that oil prices were going to remain low. Then as they moved up further, say to $30 a barrel, then the theory was that there was a $5 to $6 terror premium. And of course the basic price had risen $5 or $6 a barrel. And then as it continued to move, there was always the explanation that there was at times it was believed to be as high as a $6 to $7 terrorism premium, but of course the base price was moving all the time, and we think that that's a very, very profound indication that it's basic supply-demand factors that have been driving prices. And in time, we think that will be recognized, and it will be no longer necessary to come up with a story that the tariff premium is raising prices much higher than had previously been forecast.
So I guess what you're saying, Henry, is that fundamentals are exerting themselves, and they are the cause behind this recent rise in energy prices. What about the development of new technologies? I mean, there's a lot of press, a lot of hype on hybrid cars and all kinds of ways that we can address the issue by reducing consumption through more, efficient energy use. Do you think that there are possibilities there? Could that make a material dent in this issue? Could that change the fundamental equation?
We think that's very unlikely and within the foreseeable future, because it's important to keep in mind that we have some 800 million vehicles in the world. In the United States, the biggest market of all, accounting for about 25% of all oil consumption, we have about 235 million vehicles. They have a half-life of 9 years, and you can readily visualize that it takes a long time to change that vehicle population very, very significantly. So we're stuck with having to have conventional transportation fuels for many years to come. And I should point out, most people do not realize that in the United States, 70% of all the oil we use is used for transportation fuel, and the rest of the world is approaching the U.S. pattern. And that is the highest value use and by far the most difficult to affect and to substitute.
Henry, switching back to the supply side, I think we've had a number of questions about what is actually going on in Saudi Arabia. What's happening there. The Saudis, of course, have played a very pivotal role in the world oil scene for many, many decades as a swing supplier. And of course, not all that long ago, they indicated that they'd be prepared to, increase production to deal with problems of short-term supply imbalances. Is it realistic to expect that Saudi Arabia could come forth and be the answer to this? And what is the situation today in Saudi Arabia?
We think that's very unlikely. I should point out that one of the most important principles regarding the oil business and development of oil production there are really two factors. One is depletion, which is a profoundly important factor, and that is that from the moment you drill the first well in a new producing field and begin production, you begin depleting that finite resource, and that is irreversible. And the second is that exploration is a very rational process. You always go after the largest deposits first. They're the easiest to find, and they're the most profitable. And that gives you, over time, the classic production history of a field or a region, a country like Saudi Arabia or ultimately the world, where you raise production very rapidly as you bring those early major discoveries on stream. But then, over time, they begin their natural depletion, and by that time the newer discoveries are too small to offset those, and you reach the irreversible peak, and after that production then declines. Well, the Saudis have been achieving something of the order of 60% of their production for many years from the largest oil field in the world, the Ghawar field. It's now been producing for over 60 years, and it's a highly permeable, strong water drive formation. And all of the things now that are easy things to do to hold that production at the highest levels possible have been done. They began injecting 7 million barrels a day of seawater over 20 years ago. Then about 5 years ago began drilling horizontal wells near the crest of the field and enable you to produce oil at high rates as long as possible without the water breaking through from underneath. And then they began drilling laterals in those horizontal wells. And so we're reaching at the point where they're probably going to be seeing depletion decline rates set in of something of the order of 500,000 barrels per day or more. And they're already at work developing new fields to offset that. But each of the things they do now to substitute for that declining production from that one giant field generally require more investment, more technology input, more effort per barrel of oil developed and produced. Many, many years ago, the Saudis, with the help of some very, very talented American reservoir engineers, developed a long-term business plan, in effect, for the country. And that was that the conclusion that examining all of their resources, not only the geological resource, but their manpower, capital, technology, that 8 to 9 million barrels a day would be a comfortable, sustainable producing level that could be maintained for many decades. And they achieved that in late in 1993, and have been essentially in that production range ever since. And we think they'll be maintaining that, but having to do much more to maintain it as time goes on.
Henry, not all that long ago, the huge oil sands resource in Canada was recognized. The reserves were booked and indicate that Canada is second only to Saudi Arabia in terms of the oil resource. So I guess my question to you would be, you know, could that change the balance in the world, and what are the implications of that for Canada?
That is a very significant resource. We have been working with the province of Alberta and the Department of Energy, and with our forecast for much higher prices in the future beginning several years ago, it became clear to us that a very large portion of that reserve could be legitimately booked as economically recoverable oil. There were already efforts along those lines, and that was done, as you indicated, a couple of years ago. But it's a very capital-intensive and energy consumption intensive, in effect, mining and processing operation, and at current prices and projected prices is very economic. We would anticipate there will be continued significant expansion of that into the future. Very, very important for Canada, very important for the U.S. because Canada is one of our largest suppliers of imported oil. But in terms of making a very significant difference in this tight worldwide supply-demand oil balance, not likely to change things very much, because with total world oil production, including gas liquids, of roughly 80 million barrels per day, we currently have a base production annual depletion decline rate of approximately 4 to 5 million barrels a day. So if we were to have any hope of trying to maintain current production, much less grow it, we have to develop that quantity of new oil production every year. Or in other words, putting it in perspective, we need the equivalent of a Saudi Arabia every 2 years. That's just not possible, can't be done. And Canada's production is likely to grow another 1 million or 2 million barrels a day from the oil sands in the future. And in fact, as we extend our forecasts of worldwide non-OPEC oil production, by 2015, excluding Russia, we have Canada passing the United States and becoming the second largest non-OPEC producer in the world. So relatively speaking, very important, but not possible to change the world oil supply-demand balance very much.
Thank you for that. Of course, another topic that is ever present in the news these days is the incredible expansion of the Chinese and the Indian economies. You know, how far are they down the road in terms of moving to mechanized transportation, and what would you see their continuing impact being on the whole issue of consumption of oil going forward?
Very, very significant. As a backdrop for that, it's interesting to note that the OECD countries, all of the developed countries, are today using about the same quantity of oil that they did at the all-time peak in 1979 and 80. And essentially, all of the net growth has been in the developing world. And in fact, there's only been 1 year in the last 33 years in which there was not an annual year-to-year increase in oil consumption in the developing world, and that was in 1974 because oil prices had risen approximately 550% in that first oil crisis in 73. As that's continued, we now have this major change that you're referring to, in that the two largest population countries in the world, China and India, are now firmly embarked on the road to mechanized transportation. And in fact, last year, China passed Japan and became the second largest oil user in the world after the United States. That's an amazing rate of increase in oil consumption. And in fact, the increase in oil usage in China represents some 40% of all of the increased consumption of oil in the world during the past several years. One other area of developing country growth that's very significant, along with India and China, is the OPEC countries themselves. And particularly with high oil prices, their economies flourish, and their growth of oil consumption internally becomes very significant. So you have these three areas of major growth, and what that means in all of our analyses is that oil prices are going to have to be significantly higher than would otherwise be the case, and particularly in comparison with the last crisis, in order to restrain their growth in consumption.
Henry, one of the questions that we get asked quite frequently, actually, is, you know, what are your views on the situation in Russia, and in particular the Caspian Sea? There's been, of course, a lot of talk about that and production increases coming from there. Is that an area for hope for the world in terms of this overall scenario that you paint?
It's certainly the former Soviet Union is one of the most significant variables as we think about the future world oil supply-demand balance. Awfully difficult to get really accurate historical information from within that region. But as we have been working on this for a number of years now and have reconstructed it, the picture there is something like this, that they had a peak in oil production during the Gorbachev regime that was achieved by embarking about 10 years earlier than we did on the North Slope to develop 8 million barrels a day of new oil production in western Siberia in a very hostile, barren environment where they had to provide all of the necessary infrastructure. And they did that because their base oil production, an industry as old as ours, peaked about the same time that ours did in 1971 at a level of about 4 million barrels a day. They added this 8 to 9 million barrels a day, reached a first peak in the early part of the Gorbachev regime, then began to decline. Gorbachev needed increased oil exports for hard currency earnings for the economy, put an enormous amount of additional investment into taking that to a slightly higher second peak. It then began its natural long-term decline before the political collapse. But with the political collapse, the economy fell apart and consumption declined dramatically, and so their production fell significantly below producing capacity. And what's occurred there with privatization beginning in 1994 is the privatized companies brought in help, approximately 3,000 engineers each from Halliburton and Schlumberger. And what they've been doing during that last 10 years, during which they've increased production about 3.5 million barrels a day, is just move production back up toward the natural decline curve. And we think they're within a year or two of reaching that. In the meantime, Gorbachev, for example, diverted all of these funds away from the provinces in the Caspian area, and there's been a lot of work done there since they achieved their independence. Major discoveries there, but there are many problems to be solved. There are independent governments to deal with. There's a need for major new transportation out of that region, and there's still very limited infrastructure. They still need a number of additional marine drilling rigs to develop that. And as we've watched that, and one of my partners has been working there with a client for the last 3 or 4 years, there's a wide consensus that given enough time, assuming that all those problems are solved, the Caspian region can develop something like 2.5 to 3 million barrels a day of new oil production during the next 8 to 10 years. But we think that during that period, about 2 million of that would be offset by continuing declines in base production within Russia, leaving only a net 1 million barrel per day addition to world oil supplies from that region during the next 8 to 10 years. Obviously, not enough oil to materially affect the tight balance that we're talking about and forecasting for the future.
Mm-hmm. Particularly in the context, as you say, of world natural decline at the rate of 1 Saudi Arabia every 2 years. Henry, let's switch gears for a moment to North American natural gas. The first question I would pose to you is, what is your view on the near-term or medium-term outlook for North American natural gas prices?
Just as with oil, as I mentioned earlier, there is a regular seasonal pattern of maximum gas prices ahead of the heating season. And then, unless we have extreme winter weather, then a decline, usually reaching bottom in February, low prices for a couple of months, and then rising again after that. We've seen that sort of increase in prices. Storage levels are at very, very comfortable. Somewhat more gas than we normally have in storage at this time of the year. So unless we have very cold weather, and particularly early cold weather, we would expect a downward movement in North American gas prices, U.S. gas prices, in concert with what I'd mentioned earlier with oil. So I'd expect that we'd see gas prices moving back down toward perhaps the $6 level by February, and then rising again to the $7 to $8 level again in September, October. A similar pattern to that I described earlier for world oil.
Mm-hmm. Well, of course, I guess there is no there's no controversy about the fact that North American natural gas is declining. There might be some controversy about the point you make as to whether we're peaking in petroleum production, but certainly not natural gas. But one of the questions we've been asked is, what about LNG? I've seen several forecasts that anticipate that LNG will eventually have some material impact on the scene and translate into lower prices for natural gas. What would your comment be on that?
That's a very significant component to consider in future U.S. Gas supplies, and as we focus nearly all of our efforts now, we're content that we have a reasonably good understanding of the supply side for both world oil and North American natural gas. So the critical questions and issues now are the ones that we've been discussing here this morning, and those are what's going to be happening on the downside, what kind of price is going to be required on the demand side, and as we begin to investigate that, we've just completed a very thorough analysis of LNG expansion plans, examining all of the existing facilities, the natural gas production trends behind some of those. Some of those will be facing declining gas supplies, and the new plants that appear to be firmly financed and firmly committed, and also the same kind of examination of receiving facilities. And as we have done that work, what we've found is that the rate of increase in LNG supply is going to take longer than we'd anticipated. We'd previously anticipated a significant increase in imports into the U.S. By 2010. We now find we have to extend that out to 2014 or 2015, and that being the case, a significant portion of the new LNG imports into the U.S., which will be very important to us, will be displacing our forecast long-term declines in exports from Canada as your total gas production there peaks, and as your internal consumption continues to grow, particularly related to the continuing expansion of your oil sands processing. So that as a consequence, we had previously concluded that there would be some downward pressure on U.S. and North American gas prices by about 2009, 2010, because of the impact of these new LNG supplies. We now extend that by some 5 years or so and have strong gas prices continuing for a lot longer. And LNG in time, and then all of our work would indicate also that perhaps by 2015 we'll begin to see the first significant expansions of clean coal and nuclear for power generation in the U.S. So the revision in our work and conclusions is stronger gas prices longer than we'd previously anticipated.
One of our viewers, Henry, asked the question, what about gas supplies from the Mackenzie area? Is that material enough to change this scenario that you're painting?
As we've tried to project gas supplies out to the 2015 time frame, and again look at the gas balances within Canada, we find that gas is going to be needed to meet the needs for increased internal consumption, particularly in the face of plateauing total production, and a natural place for that Mackenzie Delta gas to move is into the oil sands processing area there around Fort McMurray.
Right. Well, thank you very much, Henry. Just delightful to be with you today, as always, and to get your views on the fundamentals behind natural gas as well as oil prices. For our viewers, we'd like to hear from you as to whether you think this is a good idea. This is kind of an experiment for us, but we would hope to, on a regular basis, bring interviews with Henry Groppe to investors in active energy, as well as the investment advisors who put their clients into this particular investment product. Clearly, the outlook for these commodity prices is pivotal to successful investing in this sector. I should add that in the case of Active Energy, in fact, the royalty trusts, for example, in which Active Energy will invest, don't need these current high levels of oil or natural gas in order to be very successful. So we thank you very much for joining us today. A reminder that this offering will be closing on November 16th. That's next Tuesday. So thank you for joining us, and we look forward to bringing Henry Groppe to you on future occasions.